Good morning, everybody, and thank you for joining us on this Apprenticeship Levy briefing session in association with the Manufacturing Technologies Association. I'm Andrea Bull, and I'm going to be your facilitator for today, and our main presenters are going to be Peter Weinbloom, the EEF Technical Training Director, and Laura Pickering, Education and Development Coordinator from MTA. I'm just going to now hand over to Laura, who's just going to say a few words about the partnership between MTA and EEF.
Thank you very much, Andrea. Hello, everyone. Yes, I'm the Education Development Coordinator here at the MTA, and I'd like to welcome you to this webinar today. Part of our education development strategy, we feel it's important to collaborate with like-minded organisations. The MTA is an affiliate member of the EEF, and we'd like to thank Andrea and Peter for taking the time to host this webinar for our members today. The MTA fully supports apprenticeships as a route for ensuring the future of manufacturing technologies industry. You'll hear more about the apprenticeship grants, apprenticeship loans and training grants that we offer at the end of this webinar. And that's it for me now, so I'll pass back over to you, Andrea and Peter. Thank you.
Great. Thank you, everybody. And now we're just going to continue with the Levy webinar. So I'm now going to hand over to Peter Weinbloom, who's going to go through the Apprenticeship Levy webinar content.
Thank you, Andrea. Good morning, all. We've got quite a lot to get through this morning, and the difficulty with the webinar is that I can't look you in the eye to see if I've lost anyone, but I'll try and keep it as logical as possible. And please feel free to get in touch following the webinar if you want to discuss any specific points. So we are going to look at the levy, the principles behind the levy, how the levy is collected, what you get back, a little bit on timings, spending your levy, and a quick look at the Digital Apprenticeship Service, or as I think they're still deciding what they're going to call it, but for the purposes this morning we'll call it DAS, and then we'll take the opportunity just to answer a few questions. So let's dive straight in. I hope you can see the slide, which is headed Scope of the Levy. This is basically just outlining that it is a tax and it applies to all employers in England, Wales, Scotland and Northern Ireland. And in actual fact, there are no exemptions, which is a bit of a misnomer because people think there are some exemptions where in fact there aren't. The tax is set at 0.5% for the next financial year. And we will look at what this is and what is considered to be the pay bill in a few slides from now. Where there is a little bit of confusion is this £15,000 allowance, which basically means it's where we get the threshold of 3 million. So companies that have got a pay bill of 3 million, above 3 million, pay a levy. Those below 3 million don't. So very simply, if you did 3 million times 0.5%, you'd get a calculation which showed you 15,000, which equates to the £15,000 allowance. There is a little bit of a complication, and that if there's a company or your company is part of a group or connected in any way, there's only one allowance, and it's up to the company to decide how that allowance, the parent company, to decide how that £15,000 allowance is distributed. But again, we'll come and look at that in a few slides, and I think I'm just going to hand back to Andrea for our first polling question.
Great, thank you, everybody. We're just going to have a quick polling question, so this will be on your screen, and if you can just answer the question, thank you. Great, thank you. So it looks like the majority of people on the webinar are in scope of the levy, although we do have a few that aren't in scope of the levy, but you'll be interested when we come on and start talking about the co-investment model, which is going to be part of the Apprenticeship Levy programme. I'm just going to now hand back to Peter, who's going to continue the slides.
Thank you, Andrea. Let's just switch over to the next slide. So this is important because whilst we talk about the levy in headline terms, even if you are not liable to pay the levy because of that calculation we've just been through, some of the rules and regulations around levy will still apply, and that's commonly called co-investment. I should just add that if you are a small business, and by small business we mean a business with less than 50 employees, you will get some of your training, your apprentice training is free, so you're not in this co-investment model. The co-investment model applies for companies above 50 and those that are below the levy threshold. Again, we just need to come back to this on subsequent slides, because even levy payers may need to take note of co-investment. When we talk about co-investment, what the government means is that they will pay 90% towards the cost of your apprentice training, and you will contribute the 10% in cash to your chosen training provider. That 90% will be restricted by the same top-up, what are called the caps, in the same way as for levy payers. So it's important that for levy payers, non-levy payers, we stick together and look at this 10%, 90%, and the caps as we go through the slides. And with that, I think we've got our second polling question, Andrea.
Okay, great, thank you. So the next polling question is just going to be on your screen shortly. If you can take a second just to answer the polling question on your screen. Great, thank you. So the results of the polling question, so if you're not liable to the levy and you're going to be using the co-investment model for apprenticeship training, so 57% of those people on the webinar today have said that that is going to apply to their organisation. So we now continue with the rest of the slides.
So just as we move on then, some definitions which really form the basis of the collection. And as I said earlier, the simplest way to view it is a tax collection. So we have HMRC involved in collecting the taxes from you, and then we have the Skills Funding Agency who will get involved in helping you to use any funds that enter into your what's called digital account. So the two main definitions are employer. That's the person who has the liability to pay the secondary national insurance contributions, and the pay bill, which is based upon the total employee earnings subject to Class 1 secondary NICs. So let's just have a look at that a little bit more detail. I've said in the first slide that the levy is set at 0.5%. We have this £15,000 threshold. So if we look at a company A as an example with a pay bill of 10 million, if we calculate levy at 0.5%, that would equate to 50,000. Less the £15,000 threshold, that company will be paying annually something like £35,000. This will actually be collected monthly, and on some subsequent slides I'll show you actually how that works in practice. So it's a significant impact on a lot of companies. There's many companies I've talked to where they've got a pay bill with lots of levy pay bill with lots of noughts on the end. So people are getting quite exercised about it. Not getting too complicated, by no stretch am I an expert on national insurance contributions, but here are some fundamental principles. It applies to all payments that you make that are subject to employer Class 1 secondary national insurance contributions, and that includes things like wages, bonuses and commissions, and it includes payments to employers who are below the lower earnings limit, employers under the age of 21, and apprentices under the age of 25. The best people who could probably guide you through this will be your payroll people, but as I said, it's fundamentally that's some of the definitions in terms of how they're using your pay bill as a base calculation. So I touched on earlier the complication about what we call connected companies, and quite honestly some companies don't know that they're connected. the important point here is that there is only one £15,000 allowance, and the pay bills of connected companies are pooled towards the 3 million total. You do get some say in the matter. It's for the companies to decide, and it's probably the parent company who will decide who and how that allowance will be split. The bad news is that you're going to make that yearly, so you have to make that decision at the start of the financial year, which we're just about to go into now in April, and you cannot change it for what will be effectively 17-18, but you could change it next April. If you're not sure whether you're connected, the best advice I can give you is maybe to look at your last company's house return or your last annual report. Failing that, speak to your auditor or see what your current arrangements are for paying corporation tax. The only caveat I'd add to that last statement is it's not quite the same as levy, but it will give you a good steer. Because connected companies, as I said, genuinely some companies don't know they're connected, and it doesn't have to be a UK connection. It could be an overseas company that you're connected to. So it is important because it will affect your levy liability and therefore what you can spend your levy vouchers on, as they're called. So let's just have a look at an example of that to try and explain that in a little bit more detail. On this slide, we're just trying to show you that we have a parent company, craftily called ABC Limited, and that has three companies: Company A, Company B and Company C. As you can see, Company A has a £2 million pay bill, Company B has a £1 million pay bill, and Company C has a £7 million pay bill. The parent company has decided that Company C will receive the full £15,000 allowance. And therefore, if we looked at their levy liabilities for those individual companies, Company A with 2 million at 0.5% has a £10,000 levy charge. Company B at 0.5 of 1 million has a 5,000 levy charge, and Company C 5.5% of 7 million comes out at 35,000, less the £15,000 allowance means they have a levy charge of 20,000. So clearly this is an example where some companies will be caught by this levy who might not otherwise have been thought that they were in scope. I hope that's clear, but as I said, connected companies is quite complicated, so I would take some advice if you need to find out whether you're connected. So having looked at that, let's have a little bit look about what you get back. The government in their announcement made the wise statement, or maybe inappropriate statement, that you get more back than you put in. I think that statement's a bit questionable. The way they've tried to sweeten that is by giving you a 10% top-up on whatever enters your levy account. So clearly non-levy payers won't get a 10% top-up. It's only those that are actually paying the tax and therefore getting some funds into what's called your levy account. You'll get this 10% top-up, and that's been set for this coming year. There's no guarantee that will roll on. As I said, I think you could view that as a bit of a sweetener. So very simply, whatever goes into your levy account, simple example, £100 a month, add 10%, you'll get £110 in that particular month. So you'd think that was relatively simple, but it does get a little bit more complicated, I'm afraid. There's something which is commonly called now the English faction, and where this gets complicated is the levy applies to all UK companies, and therefore your UK pay bill doesn't apply to overseas workers unless they appear on your UK pay bill. But all companies in the UK pay the tax. All employees, part of your pay bill, count. However, the principle that you get more back only applies to England, because the levy system, the digital account system, is very much an English system. It doesn't apply in the other devolved administrations because skills policy is a devolved issue. And the way they work this out is it's really based upon the percentage of your employees on that pay bill that have a home English postcode. You may see this done as a straightforward percentage. So our simple example there is showing that you might have 90% of your employees being with an English postcode. Actually, what actually happens is it's the value of the pay bill for those non-English postcode workers, if that makes sense. So if all your executives are in Scotland, high-paid executives in Scotland, you will lose more than the simple calculation. So I hope that makes sense. So the example here is you've got a levy liability of 10,000, 90% English employees, therefore you receive 9,000 in your levy account. So let's just move on and have a look a little bit where we start paying. Gone are the days where I could say it's a few months away. It's actually now upon us. We're into April. Your first payment will be in April. You need to declare this month to HMRC what you believe your cumulative pay bill will be over this financial year. And that's quite important if you have a fluctuating pay bill, which may come about through seasonal workers, for example. So I think the expectation is it will declare, have a little bit of forecast ahead, decide whether you're in scope, and give the HMRC some indication. And as I said, your first declaration will be in May based on your April pay bill. They will then report and provide you a summary each month, which shows you the amount you've paid based upon your PAYE schemes. And clearly companies can have more than one PAYE scheme, which is why it also gets a little bit complicated. But that is a collections by HMRC at this stage. So we've looked a little bit at collection, the bad bit, the painful bit, if you like. Let's have a look at how you can now spend your digital account. People get a little bit confused that they're thinking they're actually going to get cash back. You don't get cash back. What happens is you get an amount into this digital fund, into this digital account, and it's simply used to transfer vouchers electronically to your training provider. So sorry to disappoint, but you're not going to get cash back in your pocket. It's a virtual system where you'll get digital vouchers, as they're called. And it's clearly aimed at apprenticeships. You can only spend your vouchers on apprenticeship training, and clearly apprenticeship training that is on the national standard, the English national standard. So we can talk about frameworks if we use old language, or we can talk about standards which are currently coming on stream. The good news up till now, they've been funded differently, as have apprentices if they're over 19. And from May 17, we're now moving on to one single funding system. Just to be clear at this point, any apprentices you've got currently on programme will stay on the old scheme. So if they're currently funded through the government, through your training provider or yourselves, if you happen to be a contract holder, they will continue on that funding scheme until they complete. All new starts post-May will be on this new system that I'm outlining. One of the fundamental changes they've made is to try and reduce the number of tariffs. I spend my life looking at funding tariffs, and they've certainly reduced that to what they call 15 funding bands. And that gives us the upper cap limit that you can spend your levy vouchers on, if that makes sense. And they range from number 1 band, which is £1,500, to the top band, which I think is 15 at 27,000. And apprenticeships, and whether they be standards or frameworks, are getting placed in a band. There's a bit of a black art as to how that's going on, I think. But certainly we're increasingly seeing, and I'll show an example in a minute or two, apprenticeships being placed in bands. So you can spend your levy vouchers up to that limit. And so clearly the government funding, and it is government funding, you might think it is your own vouchers coming back into your account, but it's actually public money you're getting, which is why, and that last but one bullet point is talking about government funding, is clearly limited to that upper limit. The government are also encouraging you to negotiate that price with your provider. You will need to engage with the main provider if you are not the provider. and the government are hoping that you will negotiate that price downwards. I think it will be interesting to see how the market responds, and if we think about how the market responded when the same was applied to undergraduates, everybody basically moved up to the upper band. If you, for example, negotiate a price that's above that upper limit, it's clear that you're expected as the employer to pay the difference. So let's just have a look at that in a little bit more detail. I've already mentioned that you pay your tax in arrears, and your funds effectively arrive in your digital account monthly. So you should see your first funds arriving in May. If you then want to engage in apprenticeship training, as I said earlier, you need to select a main training provider. That main training provider can subcontract, but you have to be fully engaged in that conversation and fully aware of what's going on. And I think actually you will need to sign some funding rules, or sign an agreement to say that you agree to abide by the funding rules. And that's where you start that price negotiation, really depending upon what you expect to be delivered. And there is some good information available on the website, and I would suggest that you do read the funding guidelines, because it'll just mean you're a little bit more informed when you want to go and talk to your college or private training provider. Clearly, I talked on the last slide that if you can only spend your vouchers up to the cap. If you negotiate below the cap, you simply use your vouchers up to that level, and the residual just stops in your digital account. The way the mechanism will work is that once you engage with your provider and you do the transaction, and we get an apprentice enrollment, which we have to do electronically, and I'll show you some slides later on very quickly just how that happens, but we do an electronic transaction between yourselves and the provider. Once that process is triggered, the funds will leave your digital account on a monthly basis. Just one further complication there, not as if our life is not difficult already. They're going to hold 20% back as a bit of an inducement, if you like, to you, the employer, and also the training provider, to make sure that the apprentice does complete. You might hear people linking this 20% to endpoint assessment, which is a new process coming in for standards. Certainly, I've seen evidence that the cost of endpoint assessment might be 20% of the cap. I think the expectation is that it will be less than 20%, but it does depend upon how rigorous and robust that endpoint assessment will be. And I said the payments will flow from your account on a fairly flat profile, and I'll show you an example in a little bit of how that actually works. But there's a fairly flat profile, and you and the training provider can't really influence that. So on the next slide, let me just try and put into context the funding bands. I've mentioned there's 15, and you can see the range there. I think if we then just have a quick look at that, what I've tried to highlight on that slide is where some particular standards and frameworks are fitting in. So for example, the top left, Travel Services, Leisure and Tourism Level 2, which is an old framework, is slotted in at band 2, which means you have an upper limit of £2,000. Going down on that left-hand side, Financial Services, which is a standard, a Level 2 standard, has been slotted in at 5. More interestingly for engineers, possibly, Electrotechnical, top right, is in at 12. That's an existing framework. And Aerospace Manufacturing Fitter, just as an example, is at Level 3. As recently as this week, we have had some new standards released, which is good news. And some of those are now moving up to band 27, which is even better news. So you'll see a range. I think the thing I would point out on that slide is that if you are using frameworks, they are funded probably slightly worse than standards, because through this process the government are trying to incentivize us to move on to standards. So the next slide will just talk about another slight complication. In order for the government to try and manage this collective pot, we've talked about how the digital funds will arrive in your account in May. So it's based on your first collection, your first return for April. hits your account in May, your 10% top-up is added monthly. You obviously clearly decide when you want to start apprentice training, but that money is going into your account from May onwards. So if you're not going to start till September, you're going to get some vouchers or money into your account ready for you to draw down. The slight complication is that the government has put a limit on each of those vouchers. So very crudely, that means that the funds that hit your account in May have a 24-month shelf life. Originally that was 18 months if I recall, and that was one of the wins that we got. We argued that it should be longer than that, and the best we could get was 24 months, but it does give you a little bit more flexibility. But it means that those amounts entering your account this May will expire in 2 years' time, i.e. May 2019. The digital system that you'll get access to is supposed to be smart enough to be able to allow you to track that, and you can't influence that, but you can certainly track it. And what the process will do is use your oldest funds first. So it's using old money first and then profiling through the system. And obviously if you don't spend and they become past their shelf life date, you lose it. So I hope you're all managing to keep up, because I'm going through at quite a pace, as I said in my introduction, so forgive me for that. But let's just try and have a look at this in a little bit more detail. There's an awful lot of information on this slide, but what I've just tried to show you is a worked example. So in the top left we have a company with a pay bill of £5 million, an annual pay bill of £5 million. Slight complication that 80% of their pay bill is paid to employees that live in England. As I said on an earlier slide, remember it's not a straight percentage, it's actually the value of the non-English pay bill. But let's live with that as an example to start with. Let's look at the middle box. So we're paying 0.5% of a pay bill. So 5 million times 0.5 gives us £25,000 tax liability. Less the £15,000 allowance means that this particular employer will be paying £10,000 a year. As I've already indicated, that's going to be drawn down monthly, so if we simply divide that by 12, take into account the caveat that we might have a flexible pay bill, so it could well fluctuate, but let's do a simple calculation dividing by 12. That means entering your account each month will be £833. If you then apply the 10% top-up, so 80% of 833, and then we add the 10% top-up, you end up with £734 a month. £734 a month. I hope that makes sense. You can by all means do that calculation slightly at your leisure after this webinar, but it does work because I did it just to double check my numbers this morning. The difficulty when you get into some of this maths is a little bit of rounding. So if you take 734, I think it's actually might be 733 nearest the mark, and you multiply that by 12, you come back up to the figure of 8,800, which is mentioned at the top of that box. So fundamentally, you're paying 10,000, and English going into your English count then is 8,800. So this is clearly where you're not getting as much back as you pay in. So let's put that aside. That's what you're getting. You then want to train an apprentice. Let's assume they're going to do fabrication and welding at level 3. Let's, for example, say that goes into the cap that limits that to £5,000. Let's, for simplicity, assume that you've negotiated £5,000 with your provider. Let's assume that you've also agreed that that duration will be over 18 months. Remember, we have to take off the 20%, so 20% of 5,000 is 1,000, so that gives us 4,000. Divide that by 18 months, and that means that it comes out at £202 a month, which is the middle box at the bottom. So going out of your digital account will be £2,202 per month for that particular apprentice over that 18-month period. The far left box at the bottom just tries to demonstrate where your 20% comes back in. So in your last month, you'll get your £222, and in theory, you'll get the 20% retention payment, which was £1,000. The funding rules have just changed that very slightly. You don't get now that 20% until the apprentice actually completes, and you won't get it. You'll get it actually in the month following their completion. That's only relevant clearly if you've got people that achieve early or people that overrun. So if they overrun and, for example, they don't finish till month 23, you'll be running for a number of months without any payment, because your £222 only goes in for that 18 months that you set off from that you set at the beginning. So I hope that makes sense, but it just tries to show that in a practical example. And just some things that we just need to remind you of. You've got the 24 months to worry about in terms of your vouchers expiring. You just need to look, because we're looking here at a very simple model, but if you've got more than one apprentice, more than one provider, it can get quite complicated, but the digital system is supposed to help you manage all that. And you need to just make some provision for this, what could be called a balloon payment coming out at the end. At the moment, your training provider does a lot of this profiling. The training provider will hide a lot of this messy wiring from you. The training provider is responsible for running their funding account. What this digital system means is you've got to get a little bit more hands-on, I'm afraid. So you will need to, I would suggest, do a little bit of profiling of your levy money, maybe over 2 or 3 years, and there are tools available on the website to help you do that, and indeed we have one. But I would strongly recommend you do some profiling in terms of money that will hit your levy account, and then balance that against apprentice starts and what you think outgoings will be. So it's quite simple, just really just run it as a bank statement. So if I haven't confused you with enough what-if questions, there are others. There is an ambition that levy payers, and therefore employers with a digital account, can transfer their unused spend to colleagues, other companies. Those companies would have to have their own digital account, and that really came about from an idea that some of the OEMs or large companies might want to support their supply chain. We're still working through the detail. In fact, we've been part of the government steering group, and it is slightly complicated, probably far too complicated for me to cover this morning, but the principle is that from next year you may be allowed to be able to transfer 10% of your digital funds to another entity. Probably where that is a live issue is if any of you use what are called apprentice training agencies to employ your apprentices, which is a complication. I think, again, for a bit of brevity this morning, if you are using an apprentice training agency, certainly ask the questions, because you can't use your funds in your levy account to train apprentices that aren't on your payroll. And clearly the whole premise of an apprentice training agency was the apprentices on the ATA's payroll and not yours as the employer. And that's why we're looking for this flexibility, that maybe from next year you could hopefully transfer 10% of your levy vouchers to help that transaction. It's not simple, as I said, and we're trying to get that increased, but the government are equally concerned about complexity and fraudulent behaviour in the system. So at the moment we're not seeing any indication that it will increase from 10%. So let's just have a look at the next slide. I think that is angsting some of our, there's two things which are angsting a lot of our members. Some members are saying they're never going to spend their digital account. Others are saying they have a concern that if they overspend. There is a bit of a safety blanket here, and it's what I simply use the analogy of an overdraft, if you like. So you will have your levy digital account building up monthly as I've outlined. You've got a spend going out of that. If you go negative with that account, so you go into overdraft situation. You then straight away move into this co-financing mechanism to give you that bit of a safety blanket. So you're not left with a large bill that you weren't expecting, and equally we can still continue with the apprentices training. And that basically means that you will pay 10% of the shortfall and the government will pay 90%. Again, this gets quite complicated, and time doesn't allow this morning to work through a model of that. But just to say, as I said, think of it as an overdraft. You're paying the 10% of the amount that you're in overdraft. The government's paying the 90%. The following month, you could well come back into credit, and then you'll therefore revert to paying and using your full levy vouchers. Hope that makes sense, but it is a bit complicated. So if you are on the cusp of that, it is just worth a little bit of further thought. But do remember that whilst that looks attractive and gives you that safety blanket, you've still got your levy going out through the tax system. I touched on earlier that if you've got a variable pay bill, it does get a bit complicated. The examples we've looked at look at a very simple flat profile. The way the £15,000 allowance works that I've touched on, that again is simply divided by 12. So each month you have that threshold of £1,250, and therefore the Treasury will do that calculation. If your pay bill dips below that, you will not pay, and that will roll forward to the next month. But when it tips over that, you will pay. And at the end of the year, allegedly, the HMRC will issue you with a rebate. But we all know how difficult the HMRC is to deal with, both on a personal and a corporate level. So, but that certainly is the intention, that there'll be this reconciliation at the end of the year, and it particularly affects those that have got, as I said, a variable pay bill. So I've talked a little bit about this, the UK element of the pay bill and this English faction. So remember I said you pay the tax on your full UK pay bill, but you only receive back into your digital account the English faction. You can spend that English faction on English apprenticeship standards only. Remember I said that skills policies devolve, so Wales, Scotland and Northern Ireland at the moment are thinking about how they want to use their spend, because obviously they're going to get a chunk of your levy money going their way. Certainly from what I've read, they've got no appetite to introduce a voucher system. Certainly the notice I read from Scotland, there was no mention of a voucher system, and I don't think Wales or Northern Ireland is. So if you're in involved administration, sorry, you'll spend your levy, you'll spend your tax, but you're solely based in Scotland with a wholly 100% Scottish workforce. You won't be able to use your levy in the way I've described it. The only exception to that is if you have employees who actually do the majority of their time in England. So if the majority of their time is spent in England, you can use your levy vouchers for that training. But as I said, the arrangements in the devolved administrations is really up to devolved administrations, and we're still watching for developments. I think it's just worth flagging up, as I've flagged up there. Don't get that confused with the English faction with those that live in Scotland and Wales and Northern Ireland. Just I think a point of note that we've said on some of our seminars is just to check your records in terms of your employees' home postcodes, because it might not necessarily align to what HMRC holds, and it is the HMRC records that they'll be using. So if you're like me, when I moved house, it took me 12 months or so before I informed the HMRC that I'd moved. So there could be a bit of a difference between where you think your employees live and where HMRC think they live. So there are some other sweeteners in the system. Again, this only applies to England, but if you recruit a 16 to 18-year-old, you'll receive what they call an incentive payment of £1,000. There's a further incentive if you engage a 19 to 24-year-old who's previously been in care and have got a care plan. So 2 incentives there. They will be paid in equal instalments, so you'll get £500 at 3 months and £500 at 12 months, assuming the apprentice is still on programme. At the moment, the plan is that the payments will be passed through your training provider. So there's a little bit of a process there that you're going to have to deal with your provider to enable them to pass on that cash payment, and it is a cash payment in this case. It doesn't come out of your levy statement, out of your levy account. It's a cash payment, but there'll be a little bit of process that you'll need to engage with your provider to get that incentive back. I think it's just fair to point out that the training provider does get the similar incentive payments, so it might be worth you bearing that in mind when you're having negotiations with them. And the direction of travel is hopefully that we will be able to simplify that in future, maybe next year, and get that payment directly back to you, but that is clearly more difficult for the government to do. So we've run through what the levy is. We've run through how you can spend it. I hope some of you are still with me. Let's just have a very quick look at what they call the Digital Apprenticeship Service, commonly abbreviated to DAS, or as I've heard it talked about. I think there's still a little bit of debate what it's finally going to be called, but this is where you have this, what I could be described as a portal. And again, time doesn't allow us this morning to go through all of the slides of this, so I should just show you a couple of screenshots, so it'll be a very light touch. And the first one we're looking at here is a screenshot of the very first screen you'll see when you start to register. Now remember, this is not registering with the HMRC, the bit that I talked about earlier. That's for your payroll to do, and I would hope that they will be onto that now as we're into April. This is where you need to register with the government to get access and create your digital account. So a couple of key things that this slide is trying to point out. You need your government gateway login. That's a bit of jargon, but again, somebody in payroll or finance should know what that is. It's a gateway that they use, and if any of you have been on some of the some of the government sites now, this is getting quite common. You have a login process, but you need access to that. You'll need to know what it is, so you'll need to seek out authority to be able to use that government gateway. And the other thing that you'll need is your company's house number or charity number if you're a registered charity. And if you've got both of those, you can then press the yes button and then progress. That's just simply trying to encourage you to have all the information at hand before you get more engrossed in more slides. So there's a bit of process to go through there. Again, if you haven't looked at this, and it's live now to employers who are liable to levy, and indeed I would recommend that even those that are slightly under the levy register and try and get a digital account, because it will then provide access to this co-financing that I've talked about. Companies below 50, as I mentioned, really don't need to get involved in this level of detail. It's just worth thinking about how the hierarchy that you'll need within your particular organisation, particularly if you're involved with connected companies, because this slide here is trying to then show what you can do once you've created your digital account. So for example, in the top left there, you can create team members. So you have an option here. If you clicked on that button, it takes you into some other slides where you can nominate team members, and you can control, if you were the account super user, you can control what those team members do and how much information they see. So this is why I'm talking about it's worth just thinking about your internal hierarchy before you actually get to create your digital account. The other thing you can do there, just moving down the left-hand column, is add organizations. Manage organizations. This comes about if you're a connected company or connected, that'll hire apprentices. It also allows you to connect with apprentice providers. Going down to the bottom, probably the most important bit for your provider and yourselves maybe is that's the tab that you'll use to start new apprentices and to manage those apprentices. Looking at the right hand column, that's if you go onto that tab, that opens up into a whole set of screens which allows you to view your transactions, a bit like a simplistic bank statement. It allows you to do some of that forecasting that I mentioned earlier, so that's quite useful. It is a fairly rudimentary tool though, so it will give you an indication, but don't take it as read, because I said it will take some assumptions, not least that English fraction that I talked about. But it is useful for just doing that little bit of forecasting, and it allows you to add or remove PAYE schemes. That whole DAS system is more complicated than those two screenshots show, but as I said, it is available now. So just think about your hierarchy and get on and create your digital account. So I think that's me done now, and we're going to hand over to Laura, I believe.
Great, thank you, Peter. So Laura's just going to cover a little bit of information around MTA and what they're offering with regards to grants. So Laura, over to you.
Thank you very much, Andrew and Peter. That was really informative, and I hope everyone's gained a lot from this webinar. We like to support our members and encourage our members to take on apprentices in a variety of roles in their companies. We have a variety of trust funds in which we can support our members. We offer apprenticeship grants of £2,000 and a limited number of interest-free apprenticeship loans of £10,000. That's available to any member with an annual turnover of 10 million or less, and the only other requirement is that you must have been a member with us for at least a year. Now, unlike the Apprenticeship Levy, which is just for training provision, you can use your apprenticeship grants or apprenticeship loans to a wide variety of things such as the salaries, training equipment, of course training courses, but uniform, everything else. This can be used in addition to the funding that you get from the Apprenticeship Levy, so it's just further support for you. We also offer training grants that can be used for upskilling your existing staff. Recently, a lot of our members have been using those for HMDs, but they can also be used for leadership training, a wide variety of account management training, anything that will help to promote your business within the manufacturing technologies industry. These are all available from our website. You can see the link on the slide there. Alternatively, if you've got any more questions, my email address is education@mta.org.uk, and I'd be happy to give anyone a phone call to discuss in more detail if they'd like to find out more about how we can support them in their business. Thank you very much. That's everything from me.
Great, thank you, Laura. So we are now at the end of the webinar. We have just a couple of questions that have come through. We've been chatting through the webinar, so I'll just lead with this one question. What happens if an apprentice leaves my employment and does not complete the apprenticeship? So I'm just going to ask that question to Peter, who hopefully
Thanks, Andrea. Well, hopefully that's the situation that we don't see too often. We clearly do see it for all sorts of reasons. You have through your digital account, assuming you've got a digital account, you have the ability to stop payments to the provider. So that's the first and foremost thing. So in terms of stopping money going out to your provider when they might not be doing training with that apprentice, you have the opportunity to stop that payment. What I would again counsel is that you have that full dialogue with your provider to make sure that doesn't come as a shock to them. It does get a little bit more complicated depending upon the circumstances, and one complication I could think of is because we talk about that flat profile. If you remember, I think I used an example spread over 18 months on the slide. Certainly if we're talking about engineering provision and we're talking about first year provision, typically that can be quite expensive. So there might be a reconciliation between you and your provider if the apprentice leaves, say, partway through that first year, and the provider doesn't feel he's received enough flat payments from you to cover the cost of delivery. So that's a slight complication, I think. But fundamentally, as I said, what happens is you can freeze your payments out, and then you just need to have that dialogue with your provider to make sure you got on that commercial arrangement. The time this morning hasn't allowed us to go into too much detail because there's lots of ifs and whats and maybes in terms of what you can use your digital funds on, which is why, as I said, I would just direct you to the funding rules because it's quite important that there's some nuances in there that it's important that you just were able to get your head around, so that when you are talking to your training provider, you're talking on a level playing field, so to speak.
Okay, well, great. That just wraps up everything for this morning. So thank you all for joining us, and we hope you enjoyed the Apprenticeship Levy webinar. Thank you very much.
Thank you, everybody.
Thank you.